Stocks, as you can see, are higher so far today. Our next guest says the Federal Reserve is likely done cutting rates for 2024. Rate cuts have been a big part of the equity market rally in 2024. He remains, however, bullish on stocks. Let's go now to our next guest. He's Jason Betz, private wealth advisor at Ameriprise Financial. Jason, thanks a lot for joining us. Your view on the Fed, I believe, is a contrarian view. I can check it on my Bloomberg screen right now, but I'm quite sure the fixed income market's still calling for a 25 basis point rate cut in about 14 days from now. It is a 76% chance of a 25 basis point rate cut on December 18th. Why do you think the Fed is finished cutting rates, at least for this year?
Yeah, and I'll start by saying that it's absolutely possible that the Fed does cut rates again here in a couple of weeks. But with how things have played out in both in economic data as well as where the market has rallied since the elections, you can make a strong case for the Fed pivoting and saying that they're done for the year and that they're going to resume back in 2025. So I would say rather than I think that they're done, I think it's more or less of a coin toss rather than being written law that the Fed is just simply going to cut another 25 basis points here in a couple of weeks.
What's your view of stocks after what almost certainly now it certainly looks like we're going to have a second year of 20% plus gains on key U.S. equity markets? Are these markets overpriced?
So yes and yes. So I think that there's a good chance we could see a solid 2025 based on what we're seeing play out with economic data, with again today with very strong earnings data, specifically in a few of those technology names. That said, are we overpriced? Yes, I do think we are overpriced. And I think part of that is due to just continued optimism and continued relatively strong data play out both on the economic front as well as the corporate earnings front. Having said that, historically, if we're talking about the technology names and the AI chip makers and these big mega caps, historically we overbuy the next big thing over and over again. We've done it with hot stocks, and we've done it with alternative energy back in the 2010s. We did it obviously with technology back in the late 90s and early 2000s. That didn't play out well. NASDAQ lost 77% of its value over a 2.5-year stretch. So what I would say to investors is certainly I'm optimistic, but I also want investors to consider being more tempered with their expectations and tempered with their approach in 2025. So take a look at your concentrations in both individual names as well as sectors. If you haven't rebalanced in the last couple of years, or if you haven't rebalanced in the last year, chances are you are materially more overweight in these big technology names than you realize. And while there's certainly opportunity there, there's also an irrefutable amount of risk there. And as time goes on and as the gains continue, we as investors sometimes start to disrespect the inherent, or not show enough respects to the inherent risks of the market. So again, my message is I'm optimistic for 2025, but that doesn't mean that, we're necessarily going to be here gangbusters and there's nothing to worry about. There are concerns, and it is the market, and there are risks as well as continued future potential rewards.
So you're cautious on the risk-reward profile of the technology sector. Where do you think the risk-reward profile is more favorable for investors? In other words, where might they take some of their chips off the table in tech, and where might they put them as another place to be invested?
Yeah, good question. I think that I first would probably say I like industrials. Now, ironically, industrials have had a good year. But I think that in terms of just, everywhere you go, we're seeing infrastructure happening. We're seeing bridges and roads being built or repaired. The Build Back Better money is being spent and will continue to be spent. I think that bodes well for the industrials here, at least for the next coming 12 months. Another area that I actually think has some opportunity potentially would be U.S. small company stocks. So if we look at the Russell 2000 compared to the S&P over the past couple of years, there's been a lot of delta in the returns of those two indexes. And I think that small caps moving forward, especially if we look at a Trump presidency and the talk of tariffs, historically, U.S. small caps outperform when there are tariffs or when there's a situation, for example, where U.S. companies that are small in general just import less goods and services, they import less labor, and they import less technology support. So they're a bit of a more competitive advantage if we see material tariffs come into play. So again, industrial small cap stocks is where I would probably focus the most on right now.
Finally, are interest rates the narrative in 2025 for investors, or is the robust U.S. economy and the Trump administration becoming the new narrative?
I think the new narrative. Well, obviously the new narrative can change from day to day or week to week. But my personal opinion is going to be that it's going to depend on how the data unfolds. And if the economic and earnings data remain strong, then I think there's going to be less of an emphasis or attention or a concern of what the Fed does or doesn't do. But if the data starts to weaken or corporate earnings start to lessen, then I think what the Fed does or doesn't do then gains a lot, just a lot more traction and gains a lot more attention. So,
Jason, thank you.
It just depends on the outcome.